One of the viewers that commented on one of our posts, they wanted to know what affects them when they're applying for a mortgage, Frank. So they want to know. So I replied to them that because they asked, does my student loan, my credit card, so forth affect how much they will get approved for? And I just commented on yes, and the banks look at your debt to ratio. So can you elaborate a little bit more about that?
Yeah, absolutely. So what happens is, I guess the best way to do it is kind of give you a little bit of the process here. So, when you want to apply for a loan, the first thing, of course, is you take in the application. And some of the things that they look at, or the primary things that they're going to do, is first of all, look at income. Okay, that's a major thing. Your job security. Have you been at your job for 2 years? I mean, that's a big one. And then credit score. And then they're also going to look at how much debt you have. So it's four things there. So sorry, my dog's barking. I hope you don't hear that.
No, it's fine. It's actually, yeah, you can't hear him that loud.
So there's four things, and the two actually that come into play the most would be one, your credit score, and I would say two, your debt. I mean, because some people who don't have a high income can still qualify for a mortgage, but if you have student loans, car payments, credit card payments, anything that would show up on your credit report is going to count against you. Now, some people say, well, what about my phone bill? I have a phone bill. I have what's other things that come? I pay I don't know, sometimes like a medical bill maybe. Those
Cable
things
bills, all that stuff doesn't come into play.
that doesn't come into play. It's only stuff that if you ran your credit, like those things that come up. So cars, anything where they got to run credit for you to get that item or whatever you want to get, that's going to show up. So you got to be careful with that, because you can only go up to a certain amount depending on which area you go with. There's Fannie Mae and Freddie Mac. Fannie Mae is a little bit more strict. Freddie is a little bit more lenient in the aspect of like maybe a 5% difference, meaning let's say your debt to income ratio for Fannie might be 45%. Okay. Whereas, and this was like maybe about a month or two ago, Freddie, you might be able to go to 50, let's say. So you get like that 5% buffer there.
Right. Now, Frank, when you say, there's two things I want you to clarify. When you say it counts against them, just clarify, if somebody has a car note and they own $18,000 on their car, what you guys are taking is the monthly payment, correct?
Yeah. So you look at everything that you have. They basically take your monthly income and your monthly payments, and they look to see what percentage you're at with that. And then they'll include into that your monthly mortgage payment to finally get that debt to income ratio, so to speak.
To make sure you can afford it. Right. Because I know there's even times where somebody might even say, hey, I owe $5,000 on this credit card. They're looking at the minimum monthly payment, right? So the minimum might be $50. So that's what they're using to calculate.
Yes.
Total debt. Right.
Yeah, absolutely. I mean, they only look at the minimum payments on all that. And also too, like, there's little tricks of the trade. Like if somebody has like a car payment and it's almost done, like you're at the last 3 months, like we could not count that too. Like depending on when you close it. Yeah.
And also let me ask you, when you're applying, let's say you have 3 credit cards maxed out. That's going to affect your credit score because you have them maxed out. And maybe you would suggest them, why don't you pay half of these credit cards, so at least you're not maxed out at the
Yeah, well, honestly,
would that affect it? Would that help a little bit?
That's huge. Like, so if your credit is lower and you let's say your credit cards are all over the 50% mark, in general, a mortgage, if you're applying for a mortgage, they want to see that you're below the 50% mark on your whatever your credit limit is. So if it's 8,000, they want to see you below that 4,000 mark. They don't want to see you tapped out on your lines of credit. And if that happens and you're tapped out over the 50% mark for too long, it does affect your credit, and eventually it's going to keep dropping. Now, once you get it below the 50% mark, your credit will continue to go up. And as you make on-time payments, you got to be careful too. You got to make your payments on time. I mean, if you're 30 days late, you're kind of okay, but I wouldn't make a habit of that.
Yeah.
Right.
Yeah.
So that's, you know, that's something that we could help our buyers in the sense that, okay, maybe you don't qualify right now, but let's give you like a 3 to 6 months plan. Let's try to pay down these limits so you're under 50%, and then we could reevaluate to see if now you qualify and you could pay. Again, you don't want to have so much debt when you buy in a house, because then you're going to be over your head because you have still all these minimum payments plus your mortgage.
Yeah, absolutely.
So, you know, that's how we could guide our buyers so they understand to stay within their means, and or maybe project, you know, in a couple of months you will be in a better situation in order to get this mortgage.
Yeah, absolutely.
Right. Now the other question I had, just again, some of these things you mentioned them so fluently, and I know I understood it. When you mentioned debt to income ratio, if somebody's in their house right now and they're trying to, maybe they're 2 years away from buying a house, they have, you know, they want to get married first, have the kid, finish their bachelor's degree, master's degree. So they're not even going to reach out to a mortgage person or a realtor yet. They're really early in the process. But at the same time, they want to maybe start running a scenario in their own mind. How can they calculate debt to income ratio by themselves? Like, is there a basic formula you use, or is there a way to figure out
Let's say they make 10,000 with between them two. Let's say they make, I give you easy numbers, Frank, 10,000 a month.
And you want to know the debt to income ratio as far as
10,000. Do you look at the gross or the net when you're calculating the ratio?
You're going to look at, like, so let's, for people who don't know the difference between, you know, gross and net, what they look at before taxes. Okay. So yeah. So that's just to put it in layman's terms. They look at before taxes. So yes, the gross. And then what they do is, whatever your debt is, they let's say your debt was $5,000 with everything. That would then in turn mean your debt to income ratio was 50%. If it was 4,500, 45%. So you see what I'm
just to clarify, total debt 5,000 or monthly payments?
Well, if you're going for a loan, that's total debt.
Okay.
You know, you don't want to. That's how they kind of do it. You can't really separate that because it's kind of like a sliding bar there. You know, some people, if you have less, and this is something, if you have less monthly debt, you can afford a higher mortgage payment. But if you have higher monthly debt, you can only afford, you know, that's the less you can afford. So really, for each individual person, it can all depend. You know, two people can make the same amount, but if both of their debts are different, like one has, you know, 3,000 a month debt and the other one has 4,000 a month debt, the person with 3,000 can afford, let's say, a $2,000 a month mortgage payment.
Right.
4,000 is only 1,000 a month.
Right. So basically they'll take their income, take their debt, and whatever percentage that's it. And the mortgages, you're saying they need to be within 45 to 50% debt to income. Obviously the lower the better. And how does that affect their interest rate? Does the debt to income affect interest rate, or is that just really based on their credit score?
No, there's three driving forces when it comes to interest rate. It's credit score, debt to income ratio, and also LTV, which is loan to value.
Right.
So, you know, those are the three driving forces in an interest rate. And also too, you take into consideration if it's a single family, multifamily, that also, because the higher the risk. So a multifamily's risk is a little bit higher than a single family. So when the risk is higher, the interest rate is generally a little bit higher.
And also if they decide to do like a construction loan, a conventional construction loan, or a 503k loan, that's more risk. So the interest rates might be higher, correct?
Yeah. Like, I mean, there's, like you said, if you're doing well, FHA has the 203k, then they have like these
203k, sorry.
Builders loans. Don't worry. It's all right. They have builders loans, you know, You could get lines of credit depending on. That's a whole nother, like he said, a whole nother.
Yeah, right. I mean, the 2 or 3K conversation, I definitely want to save, because I mean, we'll go for days on and go right into the investment side almost by mistake, because they are very correlated. But the risk tolerance is again, is a conversation I think we'll save for a week or two from now.
So then, so maybe
One
like,
other, sorry, Carolina. The other thing that I know you started mentioning the question. It was Jaleesa, a friend of mine. So she did ask about the school loans and the car loans, which I think you did a good job of explaining. Um, and I actually want to just finish up on that. Is if somebody comes to you and applies for the mortgage, and you tell them, hey, look, we're about 30 to 45 days between now and closing, and like, just clarify, like, if they decide in that period to go get a new car and pick up new debt, just explain how that affects the numbers you ran initially, how that affects it moving forward, because I think some people don't realize that.
Well, that could be catastrophic if you're looking to get a house, because I mean, the one thing we tell people when you apply for a loan, basically don't do anything.
don't do anything.
And, you know, I mean, can you go out to dinner? Of course. Can you?
Right.
Don't go out and.
Exactly. Wait until after the closing to go to Ashley's Furniture to buy all the furniture for your house.
Right. Well, that's really what it is, right? I think people get excited, and just out of lack of knowledge, just don't realize that picking up Ashley's Furniture $5,000 credit card and maxing it out, and your closing is 3 weeks away. So again, explain really what that does for you and for the buyer.
Well, what happens usually, let's say most mortgage lenders, what they're going to do is, let's say you have the loan, you're ready to go. They say, okay, we're closing in about 3 weeks. And you go ahead and you buy something. Most lenders throughout the process, they continue to update the credit. Maybe not every day, but on a weekly basis to double check. And they may not do it the whole time. You may be like, oh, wow, I got away with this. And then day of closing that morning, they're like, okay, we're going to rerun credit real quick. Oh man, we can't close. You just bought a new Lamborghini. I don't know, you know, like,
I mean, in my case, a new Honda, but yeah, sure.
But it's just, I mean, and listen, I've seen it happen, you know, I've seen it happen a bunch of times, you know, even after warning people, and not on a Lamborghini, of course, but like on something small. Well, I wanted to get this new TV and, you know, it was only $1,200, but I got it on 0%. So I'm only paying $20 a month, but that $20 can make a big difference of you getting approved or not, you know, especially if the numbers are tight.
In that case, what would be the situation if they're 2 weeks out? They'd have to pay the $1,200 off in full to get their debt to income ratio back down.
Yeah.
To where it was.
And
exactly. What if they purchased, what if they got, again, they went out and got a new car that's $18,000, $400 a month. I mean, does that mean they probably can't buy the house if they were that high on their numbers?
I mean, most mortgage guys, they'll know if you have a little wiggle room, like to do something like that. Would I recommend it? Probably not. Actually, definitely not, because it does throw a monkey wrench into things. Right. Again, you know, you do that $400 a month, you're putting yourself behind the 8 ball so bad that, I mean, pretty much the loan would be dead at that point, because for a $400 increase,
that's a big difference.
It's a big difference. I mean, you have a better chance, like I said, like a little credit card, a TV, but even that could do it. So just imagine if a car, what a car would do to you.
Right.
I mean,
just so you know my stance on that, I think whenever somebody's going into the home buying process, the one thing that my understanding is you're about to make a big purchase, not just in the mortgage, but you're also looking at a lot of hidden expenses that most people, and again, I think this is conversation for another video, a lot of hidden expenses most people don't have when you live in a garden apartment or you rent that your landlord's already taken care of. So I don't think anyone should put any extra debt other than their mortgage for at least the first year. You know, a new car, unless if your car is costing you more money, clearly try to figure out how to mitigate that. But
yeah,
realistically, I don't think a new TV, right, anything. When people say a new TV, I'm like, no, you don't need that TV though. Like, you know, you really don't. like if you're thinking about it, because we bought our house last summer, and it has central air, and within the first couple of weeks, I mean, it was going into the summertime, the central air unit needed maintenance, which was several $100s, and then we got the insurance, which, so again, I mean, right moving in, we already had, if we would have spent that money, if we were tight.
If something breaks, you have to fix it.
Right, right. So again, I mean, these are conversations I think that will be going on down the road, which is why I think this is a continuous topic, because a lot of people don't realize until you've done it several times over, you don't realize the impact of such small moving pieces. You know, so I appreciate that, and I mean, you know, before we answer the other part of the question, I want to highlight the dynamic between realtor and mortgage person, and I'll let Carolina go first. How important is that relationship if you're working as a realtor and you have a mortgage person that's not returning your calls or is not getting back to you? How hard is that for you as a realtor?
Well, this is why, especially like Frank, I have known for a while and I have referred clients to him. So I have seen the time frame. You know, if he tells me, oh, we could close 45 to 60 days, we usually close between 45 and 60 days, right. You know, and he's very straightforward, and he keeps me in the loop. Oh, you know, we need to work on this, or speak to your client that, you know, we still are missing a couple of documents because maybe they won't answer his phone call or his email. Right. But when I give them a call, I was like, listen, Frank is still missing, you know, this month's pay stubs. You know, they're constantly going to ask, maybe they want another bank statement, whatever it may be, you know, and I could really explain that to them. I was like, listen, he's just doing his job. You know, his underwriter is requesting these amounts again, even though you sent it to them, you know, maybe the month before, but they need always updated, you know, bank statements, pay stubs, whatever it may be. And we have that relationship. He's able to communicate with me. Listen, is it possible maybe reach out to them? They're not answering my phone call. I need these documents, you know, and we work as a team to move it along, because if the buyer does not give the required documents that Frank needs, it's going to just prolong the whole process, you know. Right. Especially if Frank locks them in to, you know, let's say 3.5% interest rate, that's only good for what, 60 or 90 days, Frank?
Well, it depends. Like that's even a whole conversation. There's different rate lock periods. Like, for example, you have, you could do a 15-day rate lock. You could do a 30-day. You could do a 45, 60, 90, you know, so yeah, that's the whole thing on the mortgage side of it. You could play with rate locks. You could, to help get people the best deal possible. But anyway, yeah.
Right. But that goes to show the importance of that relationship between realtors and mortgage brokers, because if you're not on the same page, you might have talked to the client about locking them in for a short time, and then maybe the realtor isn't getting their job done, and now you. So I think when people are,
and then the seller's agent, the seller, and the seller's attorney are getting nervous. Right. Like, what's going on? We had a closing date of this. We're not hearing back from the mortgage or from your buyer's attorney or from the buyers. Do we still have a deal going through, or do we have to, you know, close out the deal?
Yeah. You know? And I just, you know, as people hear some of these conversations, I think it's important for them to understand that dynamic, because, you know, I always joke that everyone has a cousin or friend or a relative who's a realtor and a mortgage person, at least at one point. And sometimes I think because you want them to make money, you go, oh, let me use, you know, my best friend who has a real estate license.
Help them out.
Right, but there's real estate license, he's never used it. Or let me go, you know, to my buddy who used to do mortgages or maybe does it on the side, kind of doesn't really, and you use them and they're not even up to par. The speed or the relationship.
And you could lose the house of your dreams.
And you can lose the house. Or again, you know, if the lock-in period is over, your interest rate might go from 3.5 to 3.75, which again, the difference, and I'm going through it now where we're refinancing, the difference between 0.25%, 0.5%, depending on the size of your mortgage, can be a lot. You know, and that, again, that can go into your debt to income and and kind of just ruin the balance. So I feel like that's just an important topic that people should really focus on. And just to wrap up Jalissa's question, she wanted to know if there's any information or any current like first-time homebuyer grants or programs that are out there that she can look into. Again, she didn't specifically say when she wants to buy, but she did mention kind of is what's out there for like a first-time home buyer that you're familiar with.
Well,
You go.
me or Carolina?
Frank, please. Because I mean,
Frank,
you're the
you
person
go
that's
first, and then yeah.
Well, pre-coronavirus,
Damn.
there was a lot of programs.
Okay.
Recently, most banks went to like, you need 20% down. FHA is still functioning. You know, construction loans are iffy. So the problem is right now, the only real options are FHA. Right before coronavirus, they were doing loans that is as low as like 3% down. It was a conventional mortgage. You did pay some MI, which is mortgage insurance for people who don't know. And
right.
So, you know, there was different options where you could stick people. You know, most of the time I would put people in the conventional mortgage loan. I would try and tell them to put 5% down, because the MI that you would pay in that type of loan is a lot less. Also, it comes off after a while. Whereas FHA, your MI, or your PMI rather, they call it, is going to be much higher. Just
Now,
simple fact, more risk.
Can I ask you to explain that mortgage insurance or the private mortgage insurance premium? Where does that money go when someone's paying? Like if it's $200 a month and the mortgage person tells them, look, you're going to have to pay PMI on this FHA of $200 a month. Where does that money go to the balance of the loan?
No, that money basically goes to, it's exactly what it is. It's private mortgage insurance. So let's say you default on your loan. It's like an insurance policy that covers like the bank, not you, but the bank more so.
Right. So just to clarify, that money is going to protect the bank. It's not going anywhere into your equity or
Principal.
Okay, I just want to be clear because people hear that, oh, I have PMI, it's going to come off in a few years, but I don't think they realize you're paying an insurance to protect the bank so you can get it off.
Clarify that the reason that they're paying a PMI is because they didn't put 20% down, correct?
Yeah, and that's why. If you don't have 20% down, you're a higher risk. So in order to cover the bank, and so that they'll give you the loan, they say, okay, it's basically mandatory. And that's really the first time home buyer programs
which is FHA 3.5% or conventional with a little bit of a lower mortgage insurance premium. But there's nothing else out. Like, I mean, I know before there used to be grant programs. Like, I think Section 8 one point was doing like a grant program for Section 8.
I know in Bergen County, it's called the American Dream First Time Home Buyer Program. Okay.
Yeah.
You have to buy a property, either a single family or a condominium in Bergen County. Okay. The department is located 1 Bergen Plaza in Hackensack. The phone number is 201-336-7206. You could go there and get more information and see whether you qualify. They will get you. If you do qualify, they will help you with your down payment or maybe a second mortgage of to help pay down the house. And they will explain all of the criteria. Obviously, you will have to pay it back once you sell your home. So it has to be like, there's, qualifications, and this has to be your primary residence.
Right.
And whatever assets that you have, you still have to put it down for your down payment. So there's, criteria, but I know they do help first-time home buyers, or like if you were a previous homeowner, but sold your home and haven't been a homeowner within like 3 years, you still are able to qualify. So definitely
the American Dream program.
Yeah, it's called the American Dream First Home First Time Home Buyers is located in Hackensack, right by the courthouse. If they're interested, they could always go personally or call them, and they will give them a pamphlet. I know they have to take like a course if they qualify and so forth, and they will explain more in details on this program. But it's only for Bergen County.
Bergen County. Okay.
Bergen County properties.
Yeah.
And they do have other programs as well, like which again, if the money's there with all this that's going on, where like places that they're trying to build up, towns like cities like Newark, Patterson, where they'll even help you because you're fixing up those towns and building them up. There was programs for that too. Now again, right now, who knows what money's left? It's basically, and what I recommend people doing, and I always tell is go to Google, look around, educate yourself on some of these programs. Don't go in blind, because when you go in blind and I try and tell you something, you're like, oh, what do you mean? And it's a little bit better when you have a little bit of a background in the different types of programs. So I always recommend people, do me a favor. First, go Google first time home buyer programs and get kind of a feel of what's out there. And then when you see something that you think that it suits you or that you like or you're interested in, then we can discuss it and go into further detail, and then you'll understand what I'm talking about. And it just basically helps make the whole everything move faster, the mortgage process.
Well, look, it's me and Caroline, I think the first time we spoke, we talked about how now in schools they're introducing the topic of finance a little bit better. Realistically, if in school, seniors before graduating had to take a class on basic mortgage terminology, 10 years later, when they go buy a house, they're not getting taken advantage of, or at least they understand loan to value, debt to income, not buying a car in the middle of the mortgage process. A lot of this is, unfortunately, it's done out of a naive place. I mean, I don't say that in a bad way. It's just, if you don't know, you don't make the right decisions.
Yeah.
Which is why I've been wanting to do something like this for a long time, because people ask me questions and I give them the answers I knew, but I always tell them, look, go talk to a professional, clearly, because I haven't done anything with real estate for a long time, aside from, just buying the house we live in. But I think there was one other question, Frank, that I had, but I think again it's probably more geared towards the investor, so I'm going to leave that out. Carolina, is there anything else you kind of wanted to bring up in terms of like the mortgage side or the financing side?
No, I think we covered it.
We covered a lot. I think we covered a lot in a short period of time.
Yeah.
And Frank, if you're okay with, if somebody has a specific question, are you okay doing another call like this to answer just that specific question? Or yeah,
sure. I mean, we could do it this way. If they want to reach out to me, if you want to give them my number, that's fine too. Whatever the case may be.
Yeah.
Nelson posts, especially because he does it on Facebook. When someone asks a question, you can always reply.
Oh yeah, I mean, I'll tag you anytime I post. And again, I'm gonna edit. So before I post it, I'll send anything to you just so you can see what it looks like. And if you're not okay with the post, I won't post. If you're okay with that post, I'll tag you. I mean, the thing is, I feel like a lot of people are gonna ask questions and they're not even close to being able to purchase. So I would hate for them to bombard you with phone calls and emails if they're, 18 months. Like I have a real appreciation for commission work. I did commission for the past decade. And I know you need to spend time with the person ready to close. I know that.
Yeah.
But there's so many people that want to get to that point and just don't know how. And they feel left out. I mean, you just kind of feel like, man, nobody wants to help me because I'm not ready. And this is a perfect platform. We're spending 30 minutes in the comfort of our homes and we can go out about our day. And again, maybe in a week or two, if there's 3 or 4 questions, we'll spend another 30 minutes and building that pipeline of educated buyers that, again, will come back to you with education. And
Frank, I'm sorry to cut you off, Nelson. Frank, I think we had one client that we worked with years ago that, let's say, their credit score wasn't where it was supposed to be or it had to be in order to get a mortgage. And you are able to, maybe someone that you're able to refer to help them with their credit, because maybe they have income and everything, but is their credit, because maybe you know, their brother used their credit 5 years ago and messed up their credit,
Or they messed up their own
collection
credit.
for a medical bill. You never know, you know.
Well, there is, listen, part of the mortgage process, at least with me, the way I run things is, and my company that I work for, they, if you have like a credit issue, most of the time when we run your credit, we do like an estimation, like a credit score estimator, where it gives me an idea of what you have to do in order to get your credit score where we need it. And I could tell that person, I get a printout and say, okay, well, if you do this, pay down this, pay off that, get this, like say charge off cleared up, and and then they give me that all the paperwork that goes along with that, proving that they did the things that I told them to do. I could submit it to the credit company directly from the bank and do a rapid rescore, which usually only takes a couple days, and we could get the credit score up in a timely fashion. Whereas if you went to an outside agency, sometimes it takes a little longer, but you know.
Well, and you know, funny enough, Frank, some of those agencies are going to charge them to do the very same work that you mentioned. So no, I fully, you know, the one other thing I was going to ask was like, who else are you networking with that you feel is an essential part of a team to help somebody get to the point of being ready to buy a house? A credit person's good, a financial, somebody who can help with budgeting, whether it's an accountant or a financial advisor, financial planner, the person.
Yeah.
You know, I think people fail to realize it takes a team of people, because you're going to make a purchase that's several $100,000 worth. You know, the people that go into it thinking, I don't need anyone's help, you know, unfortunately, you set yourself up to expose yourself to a lot of risk.